How was I ever able to make over $500,000 year to date in 2022? Which stocks were successful in helping me to do this? Where is this crazy kangaroo market headed? What stocks am I focusing on for the immediate future? Hang on to your shorts, folks. It's likely to be a rollicking roller coaster ride. This is not financial nor professional advice. This video is for entertainment only. Hey everybody, before I begin too much, I want to explain how this has changed or not changed my life. This is the most money I've made in stocks in any given year, and the year's not over, and it's 544,000 to be exact. It's the best year. The best year before this was about 400,000 on Tesla back in the days when it was rocking and rolling and going wild. So, 544,000. It's a nice pile of change, I guess you would say. It's not like I'm going to go to all these wild parties, It's not like I'm going to be excessive and drink and smoke all night or something crazy like that. I'm not going to go the other route and retreat into a ashram in India and meditate 24 hours a day. It's not like I'm going to travel around the world or buy another Tesla Plaid just so I can say I drive the fastest car in the world. No, nothing that ridiculous. I'm not going to buy a boat. I don't have enough money for a super yacht or something like that. But all seriousness aside, I'm going to talk about what has been working, and it's the inverse funds, notably SQQQ, which is the 100. It's the triple leverage inverse on the 100 largest companies on the Nasdaq. It's an ETF. And I have other short funds like this. I love the triple leverage inverse funds. It's so easy. It's no work. You don't have to worry about margin calls and paying interest on what you're doing, which would drive me crazy. I don't know how people do that. But I guess they're comfortable with leveraging as much as they can get together. I would rather do it through this fund and let them give me the money for free to use, which it seems like they're doing. I don't know how they do it. It looks incredible to me. I've also used TECS, TECS, which is a triple leverage inverse fund on the 1,000 technology companies in the Russell. So it tends to be smaller companies than SQQQ. So I like it. It's been doing as well, or maybe even a little better than SQQQ. So that's why I like it. I'm also using the triple leverage inverse fund on the Chinese companies that trade on the American stock exchanges, and that is Yang, YANG. It's triple leverage, so you get $3 for every dollar that those Chinese companies on the American exchanges. For every dollar that index goes down, you make $3. And then the other very successful one is DRV, which is a triple leverage inverse fund on the real estate index. And real estate, I don't expect a massive crash in real estate just because the situation is better than it was in 2008, but I expect it to go down 20%, let's say. And as long as they're raising interest rates, that one seems the most certain of the three, although it might not in total be as lucrative as SQQQ or TECS, TECS. The one leveraged fund that I had that I sold was Dust, D-U-S-T. Think of gold dust because it's a double leverage inverse fund on the miners, the gold miners. So you get $2 for every dollar that the gold mining index goes down. That hasn't done as well, and I think it's partly because gold has gone down so much to begin with, but also I think that things are getting so bad and so serious on the stock market that actually the gold bugs and people that love gold, the gold bugs they call them. There's enough people, the gold bugs plus other people now, that are going into gold as a store of value because it is the ultimate time-honored store of value. There are many reasons that the market is going down. One of them is the Bank of England. England is in terrible shape. There's some concern that their economy could totally collapse. They are doing contradictory things because the liquidity problem is getting to be severe, and that's more of an immediate problem than inflation. But what they're doing is they've rolled out the money printer to improve liquidity. They're doing what the Fed did during COVID, during the health problems in this country, which is they're printing the money and saying that they will do anything to make the market liquid. And so they've more or less given the green flag to people wanting to invest in the market. It's the same feeling I had when the Fed said, we're going to buy anything and everything to keep the market up, which is more, they didn't say it that directly, but that was the meaning of it. And the Bank of England has done that because they're running into liquidity problems. And they're so worried about it that they've rolled out the money printer, which will make inflation worse, but at least the country won't crash in the immediate present. But what happened is traders around the world said, hey, look, one central bank has caved in. Maybe the other central banks will start to do the same thing, thinking maybe the Fed would lean more towards doing it, or at least reducing the size of their price of their interest rate increases, that they would reduce the rate at which they raise rates. But all of that is fantasy. The Bank of England doesn't want to be in the situation they're in. They're just more afraid of the liquidity problem. And the attitude is, well, we'll get to inflation once we have the country afloat. Okay. So, but I think each country affects the other, and it'll make worldwide inflation worse, which is another reason to doubt this market. I notice I'm filming this at night, and I notice that the NASDAQ is down over 1%. Okay, so, and this is after a number of days in which the market has gone down. And what I think could happen is that sometimes you get into this down phase and down phase and down phase, and you don't get any relief from it because more selling just leads to more selling, and you get what's called a waterfall sell of stocks where everything just goes over the edge and just drops. And I think we're approaching that stage. Another warning sign is Apple decided not to increase production of its Apple iPhone 14, and that's because of faltering demand, which is an indication that a recession is coming. Now, their iPhone 14 is an outstanding product. It has 1 terabyte of storage. The camera is like 48 megapixels, and you can connect to a satellite in an emergency if you're out of the coverage area of your provider. So, wow, this seems like quite an improvement. Houses generally came down for the first time in 10 years. And I noticed that Phoenix inventory has been rising faster than other places on a percentage basis. I think it's like increased 125%. Now, the number of houses that were in inventory was a low number to begin with, so it wasn't very hard for it to double. But that's still an alarming sign to see it go up that fast. So there's every sign that my triple leverage real estate inverse fund uh, is going to be a steady performer, and I've been very pleased with the results so far. Another major sign is Apple and Tesla, which have been leading the market and holding it up, are now in trouble. Tesla has gone into the 260s, and Apple has gone below 140. Yikes. Semiconductors continue to have bad news. Micron Technology, whose symbol is MU, that's MU for Micron Technology, reported that they expected to make $4 billion in revenue. That was their revenue projection. And it was only 4 billion when the street was expecting 6 billion. There is a way to triple leverage on an inverse basis semiconductors, and that's the triple leverage inverse fund on semiconductors, whose symbol is SOX, SOXS. Nike, whose symbol is NIKE, recently missed on earnings. Their earnings expectations were higher than the earnings that Nike reported. But more alarming was Nike has 65% inventory buildup, which indicates that people are not buying their merchandise, which is the essence of demand destruction. Carnival Cruises, uh, whose symbol is CCL, has gone down massively. They used to be over $70, and now they're $7. 90% down. Wow. Talk about demand destruction. One of the main reasons that the market got tanking is because of the PCE, the personal consumption expenditures, and specifically the core of the PCE. The Federal Reserve likes to look at this as an indicator of what direction inflation is really going. And they were expecting it to go up by 0.5%, and it went up by 0.6%. Okay, so it's worse than expectations, which already was bad. And then the previous month, it was only up 0.1%. So you had a massive increase of 0.6%, which indicates that the Fed's going to increase interest rates for sure. The VIX, is a measure of the predicted volatility, that is how much prices will change on the S&P 500 predicted a month beforehand. And in a bear market, the VIX tends to go up. Usually when it's over 25, you have a bear market. When it's over 30, you have a screaming bear market. And when it goes over 40, you're getting towards the bottom of the crash, hopefully. But it can go up to 60 or 70 too, as far as that goes. The VIXY, VIXY, is a 1-for-1 bet on the VIX. For every dollar, for every point that the VIX goes up, you make $1. Then there's UVXY, which leverages the VIX 1.5 times, 1.5 times. So for every point that the VIX goes up, you make $1.50. And then there's UVIX, that's UVIX, which is the double leverage play on the VIX. For every dollar that the VIX goes up, you make $2. So it seems pretty safe. We're in a bear market that's likely to get worse. So that I'm sort of playing with these, but I have some serious money in them at the same time. The big event for the future is when the PCI, the Personal Consumption Index, comes out. And that's coming out on October 13th. And the higher the PCI, the more likely it is that the Federal Reserve will continue to raise interest rates, which is bad news for the stock market. The PCI is already high. If it even stays the same year to year, that'll be bad. But if it increases month to month, that'll be horrible. So we got the big event coming October 13th when the PCI comes out. I think the Fed will be affected by employment. They want the employment to decrease for people to lose their jobs so they have less money, which will lead to less spending, which helps inflation. But the big event is October 13th. So I expect the market to trend downwards till then. I should say that the market can go up and have a bear rally at any moment just because the level of selling has gotten so severe, and that it hasn't reversed at all for a long time is an indication that people are just in the mood to either short or to sell what shares they do have. So it'll probably continue getting worse. We want to see the VIX go over 40, preferably over 45, to make sure that it's flushed out. And I usually wait for it to go down and hit that bottom, but then I want to see it come back 5% because the market can fake a recovery many times, as we've learned so far. Thanks for listening and watching. Be sure to hit the like button, smash that like button, as we say, and be sure to subscribe if you haven't done that already. Thanks a lot.